Well, I think that once you do actually start to see the interest rates going up, it might actually be better for Asian equities. One of the key things is that you look at year to date, a lot of the Asian equity markets have been relatively flat. ASEAN markets have been up slightly. But one of the key problems has been is that on the fixed income market side, you've had fairly good returns, whether it be it on the investment grade side as well as on high yield. But if you start actually seeing interest rates going back up again, potentially you might start to see some of that flow, which have actually been going into a lot of fixed income markets, maybe slowly and gradually, pulling out and potentially going back to some of the, sort of the undervalued markets, those markets specifically where there's low valuations and high earnings growth. And if you look at it, across the globe, what area provides the most opportunities right now? Well, we think it's actually here within Asia.
Okay, let's just expand on that, because the oil price, dollar and treasury yields are once again so central to the negative feedback loop and the correlation with asset prices over here. How strong do you think it is, and how do you mitigate those risks?
Well, I think at the end of the day right now, it's a lot of investor sentiment, right? Investors want to go where there's actually money to be made. So far year to date, you've had a relatively good rebound in oil prices. You have some commodity prices like gold going up. As I mentioned earlier, you've had fixed income prices going up. So that's where you've had a bit of the money flowing in. But again, once you start to have a bit more clarity, whether it be at the Fed raising interest rates in June or July, then there starts to be a bit more clarity. And then on the equity side, that's when you start to expect potentially, because there is going to be a bit more clarity now within the marketplace, for investors to actually start putting some of their investments back into equity markets. Because if you look at equity markets in general, volumes have been very low across the board. If you look at here in Hong Kong, yesterday and the day before was the lowest transacted days this year to date. So you haven't had a lot of market participants into equity markets so far year to date. And hopefully, during the second half of the year, that sentiment will start to change.
Ken, I get the sense that you're trying to tune out all the noise on the external environment, and you are adopting a more proactive investment policy. But short term, shouldn't we be de-risking portfolios ahead of June and ahead of what could potentially be another round of excess volatility on global markets?
Not necessarily, because valuations are right now to a point where here in Asia that there's a lot of value here. I mean, if you look at the all-country Asia ex-Japan market, Asia right now is trading roughly about 11 times earnings and about 1.1 times book. Compare that with the U.S., where the U.S. is roughly about 15 times earnings, 2.5 times book, and in Europe, it's roughly about 13 times earnings. So, if you look at the grand scheme of things, Asia has a very attractive valuations, and earnings are actually growing substantially higher in most parts of Asia relative to the U.S. and Europe. So, if you do need to start, de-risking or putting some of the money off the table on some of the equity investments, it would probably more focus and more narrative focus towards, the U.S. as well as Europe, where valuations and earnings aren't going to be as strong as they are here in Asia.